Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the co-founders of the Dividend Kings marketplace service on Seeking Alpha. And then, of course, many of you also know me as Mr. Valuation. You know, one of the things that I focus on quite a bit are dividend stocks. Now, I do like to look at all categories of stocks, but dividend growth investing, especially for people either at or near retirement, is a very, very important category of investing in today's world. And, you know, what we're looking for are opportunities to put our money to work so that it works as hard for us as we worked over our lifetimes to get it. And dividend growth investing can be one of the sure ways to do that because, first of all, dividends are probably the most predictable aspect of investing in a volatile stock market. You know, regardless of whether the price is going up or down, if you pick the right companies, the dividend stays pretty consistent. And I'll show you some examples of that here as we go through there. But, you know, dividend growth investing also is designed to help fight inflation on your income side, not necessarily your capital gain side, although it does work for that as well. But you really have some predictability and some control on the income side. And I think that's what's really important. So I'm going to take a look here at some dividend growth stocks. I've got 10 stocks on the list here. These are all research candidates. I want to emphasize that. These are companies that I think if you're interested in dividend growth investing and they meet your own unique goals, objectives, or risk tolerances, you might want to take a look at some of these. And the reason I say this is I feel we have a very, inflated market. Now, I also believe that it's a market of stocks, not a stock market. But having said that, the general overall stock market, if you're looking at the average as measured by the S&P 500, is very, very expensive today, in my opinion. But I think that's also a factual statement, not just an opinion. Because if you look here at the S&P 500 going back to 2001, the short recession we had then, you can see the impact of high valuation. I cover this all the time. This is often referred to as the lost decade, where, stocks didn't really do much of anything. The market didn't do anything. It really had a negative rate of return over, more than a 10-year period here. And it was primarily a function of overvaluation. I think that's the one thing that people often, especially people that are somewhat jaundiced or sarcastic about stocks, they always overlook the fact that high valuations are a headwind that even an index can't really overcome. But on the other hand, low valuations are a tailwind that can generate really spectacular rates of return. And this lost decade has led to, roughly 14 or 15 years now, one of the best and strongest bull markets we've ever had. But I do want to make a point about this. As we came into the Great Recession, marked here by the shaded area, and the stock prices fell, earnings of the market fell also, but they didn't, the whole world didn't come to an end. That's something that, people sometimes exaggerate the magnitude of these things because they're fearful when we're going through them. And fear, obviously engenders, a great deal of angst and emotional turmoil. Now, the S&P did cut their dividend during that period of time, but subsequent to that, they've had a pretty good dividend streak, the market, the S&P 500. But here's the point I want to make is there were some really good, attractive times to buy stocks, and then stocks got expensive in 2014, and they've stayed expensive ever since. And that's trading on the blue line, which is a normal PE calculation of about 17 here. That's, on the high side. I think stocks, historically trade between 14 and 16 or 17 times earnings. You can even stretch it a little bit there. It depends on the time frame you're measuring. But so you've got an orange line here, PE of 15, and a blue line with a PE of 17. And you can see we've had on the high valuation side and even, overvalued. But all of a sudden now, as we come into the, approaching the summer of 2021, we have really an extended valuation. This is really a separation from either one of these, what I would call reasonable valuation lines or valuation reference lines. The market is clearly getting dangerously overvalued, in my opinion, but it is a market of stocks and not a stock market. So what I've done, and I focus primarily on dividend growth stocks here, I turn to the CCC list. This is what's called, referred to as the Dividend Champions list, but it's made up of champions, contenders, and challengers. Companies that have raised their dividend for 25 consecutive years. That's the premier list. This is analogous to the S&P Dividend Aristocrats, just more names on it. There's also the contenders, companies that have increased their dividend for at least 10 years up to 25 years, i.e. they're called contenders, hopefully someday going into champion status. And some of the ones I'm going to talk about here are clearly doing that. And then there's the challengers, which are 0 to 10 year dividend streaks. So these are essentially dividend stocks that have had good long-term records of raising the dividends. And so I went through the contenders and I looked for valuation amongst the list of dividend contenders, which is a pretty long list. But the point is, I didn't find much. Now, I also want to make something else clear here. I've had discussions and comments and people asking me about things like healthcare and financials. There's a lot of value in those two sectors. You could almost build a portfolio of 20 different names in either one of those sectors, healthcare or financials. Now, you might be investing in the same kinds of businesses, but they'd be different names, different regional banks, different insurance companies, different types of healthcare, pharmaceuticals, maybe some healthcare equipment companies, and so on. So what I did was I purposely left all those names out. Okay, what I looked for here was additional diversification. So I tried to find stocks that were at value, that had good dividend records, companies that have increased their dividends again for at least 10 years, and some of them approaching 20 years. Like, for example, South Jersey Industries, which is a utility stock, has increased their dividend for 22 consecutive years. So it's, approaching that dividend champion status, if you will. I've got them listed here in order of lowest earnings yield to highest earnings yield. It's almost similar, analogous to the PE ratio as well, where I've got the highest PE ratios to the lowest PE ratios. The lowest PE ratios, obviously, being the most attractive companies. Now, these are research candidates. You can see I've got some good diversification. I've got electric utility, a gas utility, 2 electric utilities. I've got packaged foods and meats, aerospace and defense, agricultural products with Ingredion, and household appliances with Whirlpool, Verizon with integrated telecommunication, and even, just a grocery store, Kroger Company here. So I'm going to go look through these real quickly. Now, because I'm covering 10 stocks, I'm just going to give you an overview of valuation. And the idea here, if you like what you see, then I would suggest that you go ahead and conduct a deeper set of, research on each of these companies. In other words, look a little deeper into all of them if you like anything you see. Now, I also want you to notice dividend yields. My dividend yields range from what I would call very attractive, 4.6, 4.6, 4.78, all the way down to 1.7, 1.33. But the ones that have the lower dividend yields, as I'll illustrate, have a little more growth potential, and valuation also comes into play. So let's go through these 10 names kind of quickly here for you. I'm going to start again with Oklahoma Gas and Electric, or OGE Energy, which is an pure electric utility. And, this is a very interesting story here. And I think you get the first glance at what I mean when I said earlier that dividends tend to be the most predictable. Now, this company froze their dividend for several years, or maintained their dividend for several years from 01 all the way through 06. Then they've got a nice streak of increasing their dividend. Now, they've raised their dividend for 14 consecutive years now, which puts them in that contender status. But they also maintained their dividend prior to that. So it's got a good long-term dividend record. When you're looking at the price and even the earnings, the orange line on the graph is earnings, the black line is price, you can see that there's a lot of volatility, i.e. unpredictability, when you're dealing with those things, okay? But the dividend was real steady, and that's what I'm looking for with these particular group of stocks. Companies that you can invest in, if you can get them at attractive valuations, then you can tap into their dividend yield. In the case of OGE, we've got 4.66% dividend yield, which is very attractive. The earnings yield's a little light. In other words, the stock's a little bit above the orange and the blue line here. So I would say I'd like to see this a little cheaper, but on the other hand, a 4.66% dividend yield might, entice me to say, okay, this one might make some sense if you're looking for income and growth of income. Now, also, you've got an earnings growth rate of only 3.8%. And when I look at performance here, you're going to see that the dividend growth rate has been under 5% a year, but it's been a healthy 5% a year. There was no dividend growth at all for these years here from 2001 through 05, as I mentioned to you earlier. And then the dividends grown nicely. And there are some years where they increased the dividend at double-digit rates, and other years where they don't. But the point is there is a consistency in the fact that your income goes up year after year after year. This stock is moderately attractively valued right now. It's BBB plus rated, has 41% debt. This would be a utility stock that I might suggest if you can get a little cheaper, you might want to take a closer look. But it's a good quality company in the heartland of America, if you're a utility company in the heartland of America. The next company I want to feature is Kellogg, the cereal company. Now, what's interesting about companies with strong brand identification like a Kellogg, you'll see this quite often, where they tend to trade at a premium valuation to what I would call their intrinsic value, which would be the orange line in the graph. But having said that, I do want you to note that there are several times where if you're patient, and I guess you could say opportunistic, you can buy a stock like Kellogg, when it's trading at a low valuation. And that gives you the opportunity to get moderate growth, about 4.5% growth here, a little bit lumpy. I do want to point that out. But again, we have the dividend streak that I talked about. Kellogg has increased their dividend for 18 consecutive years. That's a very, very good streak. You can see there was some, in the beginning here, we had some years of maintaining the dividend, but then the dividend has grown for the last 18 years in a row, and that's really a good advantage. The dividend growth rate again is about 4.4% historically. You can see the single-digit dividend increases, but the company does increase the dividend, which does give you a raise in pay, and that's a very predictable aspect. Again, the stock price is very volatile, and with low growth stocks like that, you really want to be careful and not pay high valuations for them, like you have here. Even when it's got high valued up here, you only made about 3 or 4%. Now, if you can buy the same stock, when it's cheaper, I didn't pick the very bottom there, you can kick that up to about 6%. But these aren't really about making a lot of money. These aren't about capital appreciation. They're about dividend yield. And here we've got 3.54% dividend yield for BBB rated Kellogg, the cereal company. And it's just a good, solid, business that you could invest in today's market without taking a lot of valuation risk. I think that's the real key. A little bit pricey. I'd like to see this one a little cheaper as well. It's below its normal PE ratio. So if I'm looking at this from its normal multiple, it does look attractive. I look at it from the intrinsic value, it's slightly overvalued, but it's not bad no matter how you cut it. So you might want to take a look at Kellogg, those of you who are interested in a 3.5% dividend yield. The next one I will look at is another utility, South Jersey Industries. And again, I want you to see the predictability of the dividend income stream. That's what makes these dividend stocks attractive. South Jersey Industries has increased their dividend, as I mentioned earlier, for 22 consecutive years. So they've got a really good dividend streak. Again, dividends are so predictable relative to the volatility you see with stock prices. And you can see these, how dangerous overvaluation can be. Again, we have about a 5% grower here. These aren't big, money, 10-bagger type stocks. These are steady dividend stocks. You can get a 4.6% yield here. I'd like to maybe see this one a little bit lower valuation itself. A 6.3% earnings yield isn't bad. I like 6.6 to 7% earnings yield, but this is at least acceptable considering that I've got an above average 4.6% dividend yield in today's low interest rate environment. The stock has been recovering from a low valuation. That's usually a good sign for companies like that. So you might want to take a look at South Jersey Industries if you're looking for above average current income with moderate dividend growth. Growth has averaged about 6.3% historically over that 22-year period that I referenced. The next one I got is Northrop Grumman, and this is, obviously an aerospace and defense company, BBB plus rated. I do want you to see that this is a case of where valuation was low. I've had some comments about that recently. People aren't willing to be patient for 3 or 4 years, but I think this is the classic example. If you would have invested in this stock back here when it was trading at, let's say, a 10 multiple and held it to today, when it's still fairly valued, you make 20% a year annualized. Buying good companies like this at attractive valuations is, really a good way to invest. We've got about a 1.7% dividend yield here, but the difference is we've got some really decent capital appreciation potential going forward with an 8.6% growth rate. Now, again, if you can buy this stock a little cheaper, the better it would be. Longer term growth rates are expected to be about 8.5%, and this one could be a 9 or 10% annualized rate of return with a decent dividend yield. The big difference here is the dividend yield has grown much faster at about 11% a year, which means that it really outperformed the S&P on a total income and capital appreciation over the long run here. But the key is, this would have been a much more opportunistic time, obviously, to buy Northrop than it is today. But if you get this stock a little cheaper, it's one. But again, in today's overvalued market, it's really hard to come by good value. Northrop had 17 consecutive years, by the way, of increasing their dividend. The next one is Ingredion, and I'm going to take a quick look. A lot of people don't think they know, this company and what the company does, but they are really in a lot of different, beverage ingredient solutions, industrial biomaterials that replace synthetics with fibers, beauty and home. They get involved in health, in hair care, skin care, sun care. Paper and packaging is a big product for them. So, they're actually a pretty interesting little company. Again, I see a much more consistent dividend record than I do price volatility. And you can see there is some cyclicality here. The stock is very reasonably priced. It's forecast to grow at about almost 7% a year, which again gives you a nice solid returns with a 2.7% dividend yield. The company's historical performance, the dividend has grown at double-digit rates. That's the attraction here. This is one you might want to look at. You can see, if you get these stocks like this on the right side of the cycle, they can do really well for you. This company only has 37% debt. It's BBB rated, and it's just a good basic type of business that you might want to take a look at and invest in. This is one that I find very, very interesting. It's Silgan, and they make metal and glass containers, jars and cans and so on. And they're kind of an old school, but look at the growth rate here. We've got almost 12% historical growth. The dividend growth here has been 18 consecutive years of increasing the dividend, which they just started paying in 2004. Ergo, the 18 years. You can see their growth rate of dividend growth rate has been about 14% a year. They've really thrown off a lot of income relative to the average company and have really generated significant capital appreciation. Now, going forward, they're not expected to grow as fast as they have historically in the 6 or 7% range, but you can buy this company cheap enough to get double-digit returns here, about a 1.3% dividend yield, and it's again, a very interesting company. This is another one that you might want to take a look and go into their corporate website. You can see that their major customers are companies like General Mills, another cereal company, Campbell Soup, Colgate-Palmolive, Conagra, J&J, of course, SC Johnson, household cleaning products, PepsiCo, Nestle, Unilever. So they've got really a who's who of customers that they make cans and bottles and so on for. So again, another nice basic stock with a really excellent long-term track record, good average dividend growth rate of 14% per year, and 18 consecutive years of increasing the dividend. So you might want to take a look at this one. The next one is Edison International, another utility stock. Once again, we get, mid-growth on the company, but this company has increased their dividend for 18 consecutive years. They started paying a dividend in 2003, and they've really, increased it dramatically. Now, when you look at dividend growth rate here, it's a little contaminated by 2004, where they more than tripled their dividend. But if I shorten the time frame a little bit and get rid of that growth rate, you can they still see they've averaged about 7% dividend growth. Company is, one of the highest yielder in the group, 4.78%. I consider it very attractively valued. The combination of low valuation and high dividend yield probably gives this one of the best, rates of return over the intermediate term anyway of any that I've shown you here. But it's really a function of having a chance to see the valuation revert to the mean and get you PE ratio expansion. Their normal PE's been between 14 and 15, and that, would give you the opportunity to make really strong rates of return with a 5% dividend yield while you're waiting for that to occur. So you might want to take a look at Edison International, one of our old line utility stocks. Whirlpool is a very interesting stock, obviously household appliances. Whirlpool has increased their dividend for 11 consecutive years, which is, very attractive. You can see they had kept it frozen here for a couple of years in 01, 2, and 3. Their dividend growth rate has been about 7% a year. Compound average growth 6.9, average 7.2. They've thrown off a lot of dividend income relative to the market, and they've outperformed the market even during this great bull run over this long-term time frame. The stock did get very inexpensive. I produced videos on it in the past. You can check them out when the stock was really cheap. It's now kind of moving back into an 11, multiple. It's got an earnings yield of 8.54%, was extremely attractive, a dividend yield of 2.3%. And it's got really nice growth potential and capital appreciation potential over the next, couple of years especially. I think this is one that you also might want to take a close look at. Moderate yield, more capital appreciation in the case of Whirlpool. Going on to Verizon, a lot of talk with AT&T now. Those of you who are squirrely about AT&T, I recently did a video on it. You might want to take a look at Verizon, a dividend yield 4.46%, triple B plus rated. The company's got decent, rate of return potential going forward. Their long-term record, their dividend has only grown by about 3% a year. They have increased it for 16 consecutive years, though, as you can see here. And prior to that, they maintained it or kept it at, $1.38 from 2001 through 2004. Not a lot of growth again, only about 2.6% growth, but good valuation, good yield. You might want to take a closer look at Verizon if you haven't already. Kroger, getting back into the food business. These are low margin but consistent margin businesses. But Kroger has actually kind of defied that to a great extent. They've grown at about 7.5% a year. Their dividend has increased for 15 consecutive years. They've averaged almost 13% dividend growth. That makes them very attractive. The stock is only trading at 11 times blended PE with about a 9% earnings yield. Dividend yield about 1.98%, dividend growth of over 12%. You might want to take a look at Kroger. It's got a big spike in earnings coming up right here. That's something you might want to check out. Forecasting, it is expected to grow again. That says a negative return because we're factoring in this 58% growth rate. If you look at longer term trend line growth rate, it's expected to be somewhere between 7 and 8% going forward, which is consistent with their historical growth. So you might want to take a closer look at Kroger. Those are the 10 research candidates I've offered for you for this particular video. These are stocks that are reasonably valued at a very overvalued market. They're all good quality companies. They're not great. They're all investment grade except for Silgan, which I actually really like this company. It's only double B plus, but the rest of them are all triple B or better, up to triple B plus. Good solid companies. Many of them recognized names. You might want to take a close look. Anyway, it's been Chuck Harwell saying thanks for watching. I'm just trying to give you some ideas here in this inflated market that you might want to check out. Thanks for watching. If you liked the video, give me a thumbs up, give me a like, ring the bell, subscribe to the channel, etc. I appreciate you guys. I'll talk to you again real soon.